Chairman Jones, I think your button is pushed. Will you get the one on the end down there too? There's one pressed down there. Thank you, sir. I'm glad you're useful for something. All right, y'all. Thank you for being here. I'm going to kick off this meeting of appropriations. Kick it off, and I'll start by asking Representative Donahue if he'll open us in a short prayer.
Thank you, Mr. Chairman. Heavenly Father, we just thank you for this day and thank you for watching over us. We pray that you're with our family as we're away. Give us clarity on the decisions we make for Georgia. All these things we pray in Jesus' name, amen.
Amen. Thank you. So, as you all know, we missed this presentation because of the blizzard on South Georgia. And I'll be first to say it was a nice blizzard. I loved it. So I felt like we really needed to hear from our state economist, Dr. Bob Bushman, about some of the things he does and uses to help project the governor's revenue estimate, and so we'll see what he has to say. And I hope, Bob, you're available for questions, I guess, afterwards, or if the moment arises during the presentation. Is that okay? Okay. Well, I'll turn it over to you. The floor is yours.
Okay. Good afternoon, everyone. I hope you can hear me okay. For those who don't know me already, again, I'm Bob Bushman, state economist for almost a year and a half now.
Pull the mic a little closer to you.
How's that?
Yeah, that's
okay.
Better.
Previously, I was with the Fiscal Research Center over at Georgia State, so my interactions over here were mostly with OPB and the tax writing committees. So thank you, Chairman Hatchett, for inviting me to speak to your committee today on the economic and revenue outlook for the state. Thank you as well to the committee members and others in attendance. My presentation today is in three parts, though the first two are partly mixed in order. First, state revenue trends and the structural and economic contributors to those trends. Second, U.S. and Georgia macroeconomic performance. And third, the outlook and the risks. First, to recap revenue trends, this graph shows tax revenues by major tax type since fiscal 2019, starting at the base with personal and corporate income taxes, followed by sales, motor fuels, TAVT, etc., until you get to the very tiny ones. Over 5 years, state tax revenues have grown cumulatively by $9.3 billion, or about 38%. But it's important to note that 91% of that growth, about $8.5 billion, came in just 2 years, fiscal 2021 and 2022. The state's three largest revenue sources, personal and corporate income taxes and sales taxes, grew by $8.9 billion over the 5 years. Other taxes performances varied, especially the motor fuels tax, which, as you know, was suspended for various parts of fiscal 2022, 23, and 24. As the figure makes clear, total tax revenues have been essentially flat since 2022, in spite of the motor fuels tax suspensions that had their biggest impact in 23, as well as substantial income tax cuts that took effect in the second half of fiscal 2024. In numbers instead of pictures, here's a recap of fiscal 2024 performance compared to 23, as well as year-to-date, at least through December. I was still missing a number for insurance premium taxes when I made this slide. Year-to-date this year compared to the same period last year. As you can see, fiscal 2024 personal and corporate income taxes were both down, but not as much as we feared 14 months ago when we were concerned the Fed might not engineer a soft landing. These declines were partly the result of tax cuts that took effect mid-year and a little bit more after enactment of the additional 10 basis point cut, and then matching the corporate rate to the personal rate that didn't take effect until later in the year. The declines there were offset by gains in motor fuels due to only a very short suspension in fiscal 2024 compared to the one the year before, leaving total tax revenues essentially flat. The bottom line was up 1.4%, or about $1.5 billion, due entirely to gains in interest income on the surplus, both from larger balances in the reserve accounts, as well as higher short-term interest rates. Year-to-date, total taxes and total general funds are up modestly, 1% and 1.9% respectively. Again, with motor fuels gains that offset income tax declines. On personal income taxes, though, the decline of 2.4% is considerably smaller than the cut in tax rates. Remember, we were at 5.75% in the first half of fiscal 24. We're at 5.39% in the first half of the current year. So if incomes were just flat, we'd expect about a 6.25% decline in collections. We don't see that. We only see 2.4%. So this suggests that the incomes of Georgians are still growing at a healthy pace. So let's look more closely at income performance. This graph, which those of you who were here last year saw a similar one with a year less observations in it, shows what's happening with Georgia and U.S. personal incomes since the last quarter of 2019, just before the pandemic. These data are seasonally adjusted for inflation, and indexed to 100 in the first period, so you can see the cumulative growth over time. First, the solid lines show total personal income, including from employment, from dividends, interest and rents, and from transfer payments, hence the spikes. Georgia in orange and the nation in blue. The dotted lines show only the wage and salary component of total personal income. Those are the lines you should focus on, not so much the ones with the spikes. On total incomes, though, we ended up the nearly 5-year period up about 9.4% nationally and 10% in Georgia. Inflation adjusted again. Not bad at all, but wage and salary income, the dotted lines, did better, at least in Georgia. National wage and salary income was up 8% cumulatively over the period, while Georgia wage and salary income was up 12.1% and continues to climb through the third quarter of 2024. Georgia continues to outperform over the last 4 quarters, beating U.S. wage and salary income growth by 0.5 percentage point, 3.1% versus 2.6% over the 4 quarters. Wage and salary income is really the main driver of personal income tax revenue growth over the medium and longer term, so let's look at that, our biggest revenue source. Taxes on wage and salary income are collected generally through withholding, as you know. And historically, withholding collections over the entire year have been approximately equal to total income tax collections. In other words, the sum of other payments, estimated tax payments, payments with returns, less refunds, averaged close to zero over the entire year for 2015 through 2019. That dramatically changed in fiscal 2022 and 23. So this graph shows both withholding and total net collections, the total being in orange, on a quarterly basis since fiscal 2015. Plus the four-quarter moving average of each, the dotted lines. From 2015 through 2019, these dotted lines are nearly equal, but since then, average total collections have far exceeded withholding collections alone. For fiscal 2022, the gap between the orange and blue lines represents an extra $3.9 billion of net collections over and above withholding, or almost 2/3 of the $6.1 billion gain in total income tax collections from 2019 through 2022. These non-withholding payments primarily come from estimated and final tax payments, less refunds, and except for the refunds, they're generally related to income from business, from self-employment, or from investments, including capital gains income. Refunds, either from withholding against over-withholding against wage income or overpayments of estimated taxes, offset those other payments. And as I said, for several years before the pandemic, all these payments together, net of refunds, tended to sum to zero over the year. A big part of the $3.9 billion positive gap in 2022 was tax on capital gains, and I'll show you more on that in just a second. The gap has disappeared more recently, though part of the reason is the implementation of entity-level filing by business pass-throughs, which can now file, as you know, on and pay taxes on an entity level through the corporate income tax. In fiscal 2023, about $1 billion shifted from personal to corporate income taxes because for that reason alone. Finally, withholding collections have benefited from the real wage and salary income growth I showed you on the previous slide, though withholding has leveled out in the last year and a half, partly due to tax cuts and partly to less of a push from inflation. Now, as I said, I show you what's been happening on capital gains. I showed you this last year as well, obviously with a year less data. The table shows capital gains data reported from two sources, DOR and the IRS's Statistics of Income program. One set leaves out some people, non-e-filers. The other leaves out non-residents and part-year residents who moved out in the middle of the year. We have the amount, from both of them, we have the amount of capital gains reported and the number of filers with gains. So using the IRS data in particular, we calculate the amount of tax that would be owed at the top statutory rate for that year. So tax year 2021 was a great year for gains. As you can see, producing an estimated $3.1 billion in tax that would generally be revenue for the state in fiscal 2022. That fell nearly in half in tax year 2022 or fiscal 2023. The graph shows the distribution of those gains realizations across returns from those with less than $100,000 of reported gains to those reporting more than $25 million of gains. As you can see, that group at the top, reporting very large gains, is also quite volatile. It's likely that most gains of this size are coming from the sale of business, or at least a very large stake in a business. And we can see booms and busts in these very large gains twice in the last 7 years. But you can also see that tax year 2022 was a big year for capital gains of all sizes, as well as for a greater number of taxpayers, and that the biggest reversal in tax year 2022 was in the largest gains category, which fell by about 70%. We don't know yet, unfortunately, how this looks for tax year 2023. We have the revenues, but we don't have the data to dig into where that income's coming from.
Can I ask a question on that
Yeah.
one right now? You know, yes, dollars, $3 billion more dollars in fiscal 2021, but you look at, and you may have just talked about this, how the number, so many more returns were filed. Do we have any idea why, or is that just on capital gains
This
filers?
is just returns
Just on
reporting
capital gains.
gains.
Okay,
Yeah,
not
net
everybody.
capital gains. So if they
Okay.
if they had
All right.
if they had net capital losses, you know, the $3,000 maximum you can take, then they aren't in here.
Okay.
But yeah, those reporting positive capital gains.
Okay.
Yeah. Income growth contributes to state revenue growth in another way, through the sales tax. Sustained growth of ordinary personal income, income from a job or business, or from dividends, interest, and pensions, is the main driver of sales tax revenue growth. Nominal personal income growth in Georgia, excluding transfer payments, averaged about 5.5% per year over the last 5.5 years, while sales tax revenue grew by an average of 7.6% per year from fiscal 2019 through 2024. So what explains the faster growth of sales taxes than income? Part of it was spending the pandemic assistance payments, but that effect had pretty much dissipated by this time last year. The other big factor has been the mix of consumption spending. Beginning during the pandemic, consumption shifted from services to goods. We were all sitting at home, so we ordered from Amazon instead of going to movies or restaurants or taking vacations. Goods are in this graph in red, and services are in green. So there was a huge shift that really reversed a 50-year trend toward more and more consumption spending on services and less on goods. These data are for the US because state-level consumption spending are only released annually by BEA with a long lag, but the picture is much the same in Georgia through the latest state-level data available. As you know, goods are generally taxable in Georgia, except for at the state level, except for groceries and prescription drugs, while most services are not. So the shift boosted sales tax revenue growth for the first 2 years after COVID hit. The shift back towards services since then has been a drag on sales tax revenue growth in fiscal 2023 and 24. But the lines converging again means that the mix of goods and services consumed has returned to the pre-pandemic mix, and the drag on sales tax collections should be over. So to recap, a few key observations on revenues. Strong nominal wage and salary income growth continues to drive withholding collections. 0.6% fiscal 2024 withholding gains come after a 6.25%, roughly, or 36 basis point rate reduction in the second half. Year-to-date fiscal 2025 withholding is down 3.6%, implying wage income growth of about 2.4%, accounting for the tax rate cuts or adjusting for the tax rate cuts. Year-to-date non-withholding gains come mostly from about $188 million less in refunds paid out during the 6 months. The boost to sales tax revenue growth from spending of excess pandemic savings, high inflation, and the consumption shift from services to goods is over. The return to normal slowed sales tax revenue growth to 1% in 2024, but it shouldn't have a continuing effect, a continuing drag on sales tax revenues. Now let's look at a few other broad measures of current economic conditions and performance over the last year to set up for the 2025-26 outlook. First up, unemployment. National unemployment remains low at 4% in January, 4.0. The national number hit 4.2% for a couple of months last summer and then again in November. So we're still in that, we're staying in that 4% area for now. Georgia, meanwhile, has been overperforming on this measure for 5 years now. We're at 3.7% as of December, so we're up 0.5 point in the last year, but still 0.4 below the national reading as of December. Low unemployment is obviously good for consumer confidence, supporting taxable consumption, and puts upward pressure on wages, contributing to taxable income growth. Also, since February 2020, Georgia non-farm employment has outperformed, growing by 6.9% cumulatively versus 4.4% nationally. The BLS survey of households reports a near record 5.21 million Georgians employed as of December, 52,000 more than at the end of 2023. Growing employment leads to growing output from businesses, which brings us to the broadest measure of economic performance, GDP, or more specifically, inflation adjusted or real GDP. The headline result is that Georgia and U.S. real GDP growth, shown here, indexed to 100 as of the fourth quarter of 2019, before the pandemic, have grown by 12% and 11.5% respectively on a cumulative basis since pre-pandemic highs. So Georgia at 12%, the U.S. at 11.5%. After the initial plunge from the pandemic, both national and Georgia economies recovered quickly in terms of real GDP. Growth has stayed mostly positive every quarter since then, with a couple of exceptions, even in the face of Fed rate hikes beginning in March of 2022. Georgia outperformed the nation through the end of 2022, then lagged briefly, and then slightly outperformed again through 3 quarters of 2024. On to a favorite topic of last fall, inflation. This graph shows you the inflation surge that prompted the Fed to raise rates a couple of years ago, 11 times in 17 months. Headline inflation, the all items consumer price index, shown here in black, peaked at 9% year to year in June of 2022, far above Fed targets, but came back down to just over 3% a year later. Unfortunately, it's stayed in that area since. The green line shows inflation in goods prices. Goods prices, as you may recall, with supply shocks everywhere, kicked off the inflation rise in 2021 and peaked at 14.2% year over year in March of 2022. Since then, goods inflation has fallen dramatically. It's been no higher than 1.4% since May of 2023, and 0 or negative in many months since then, so averaging essentially 0 for going on 2 years. So why isn't overall inflation back where the Fed wants it, around 2%? The reason is services inflation, which accelerated while goods inflation was easing. Services inflation peaked 2 years ago and is still high at 4.2% year to year as of January. The biggest component of the services price index is shelter costs. It's about 2/3 of the weight of the index. Those peaked a bit higher and a bit later, but shelter costs too have been falling. Services in general and shelter in particular, though, have been holding up the overall inflation rate over the last 2 years, really. Monetary tightening had partial success in bringing inflation down, allowing the Fed to cut interest rates a full point between September and December last year. But the Fed is likely to sit tight for a while this year, given the latest inflation readings that have ticked back up, as well as a lack of other signs of major slowing in the economy. So bad news and good news. So here's a picture of Fed policy since the Great Recession. The target Fed funds rate upper and lower bounds. A year ago, we were in the middle of that long pause at the top. Most observers thought then that the Fed would begin cutting rates in March, as y'all may recall, with further cuts over the rest of the year. I forget how many, maybe 3 more cuts over the rest of the year. I said a year ago that inflation was still high and that if they start cutting rates in March and continue cutting rates, that wouldn't really be good news. It would be an indication that they see us dipping into a recession. They waited 6 more months and engineered something a little bit better than a soft landing. Then, as inflation was easing over the year, they started in September, 3 rate cuts totaling a full percentage point, bringing us down to a target range of 4.25% to 4.5%. But slow progress in inflation, still low unemployment, and strong growth likely keeps the Fed on hold for further rate cuts for several more months. As of this morning, the Fed funds futures market implied probabilities of where futures market participants expect the Fed funds rate to be over the next 2 years of FOMC meetings suggest only 1 quarter-point rate cut over the rest of this year, likely in September, so nothing until September. After that, no further cuts until the end of 2026, December 2026. That's actually good news on the interest earnings on the surplus, so it helps. The question is whether the Fed is staying firm because of continued strong growth or stubbornly persistent inflation. So far, it's a little of both. So what is the outlook for the economy then? I'm going to show you, it's still a favorite predictor of mine. I showed you this last year as well. It was one of the reasons I thought we might be heading into a mild recession last year. This is the 3-month to 10-year Treasury yield spread. Since 1959, every time this spread went negative on a monthly average basis, a recession followed within 6 to 17 months, except once, when it went negative in early 1967. No recession since 1960 has occurred without this yield spread turning negative. So 1 false positive and no false negatives, right? Or do I have that backwards? This predictor broke its streak. It had 8 straight correct predictions with no false predictions since the 1960s. It's now been 26 months since the spread went negative in November of 2022, and the spread is now positive again. I didn't update this for the January average, but it's as of January, it's a positive 32 basis point spread. So it was wrong. I could tell you why I think it got a false reading this time, but that's way beyond the scope and the time we have. So I will move on to some of the other positives. Let's look instead at some what I think are important indicators of the outlook. First, the banking system is still strong. I don't know how many of y'all in here are bankers, but banks have been building their capital ratios pretty dramatically since the Great Recession. The Fed didn't really give them a choice initially, but they've been continuing to build their capital ratios. This graph shows regulatory Tier 1 capital as a percent of risk-weighted assets. So pretty steady improvement in bank capital ratios going back to 2009. It's gotten a little bit more volatile lately, but still very healthy banking system. What about the consumer, you may ask? They are financially also still pretty strong. Households have added debt since the pandemic helicopter money was used to pay it down, to lows not seen in decades. And rising interest rates have increased the payment burden on many types of debt. But the burden measured here as debt service payments to disposable income of households is still lower than at any time since the late 1990s. Consumer loan delinquency rates also remain low. Mortgage delinquencies, shown here in blue, usually start to creep up before a recession, but we're not seeing that now. In fact, the only time in the last 25 years that mortgage delinquencies have been lower was a full 2 years before the Great Recession hit. So there was still, after that, some buildup in leverage in households and banks taking crazy risks on the mortgages that they issued. So pretty healthy mortgage market. Credit cards in red, and overall consumer loan delinquency rates, so including auto loans and things like that, are also still at historically low levels. Delinquency rates for business loans And total loans for commercial banks are also at historically low levels. And as I said, banks are well capitalized as well. So the consumer is still in good shape financially. And if or when the economy slows, unlike 17 years ago, we aren't going in with conditions set for a financial crisis. The worst recessions arise out of financial crises. So it's good to know that the risk of another one like the last is quite low. That's the good news. Now, what should we worry about? High interest rates on mortgages and other consumer loans. So in red, we have mortgage loans, and the blue dots are bank auto loan rates. So high interest rates on mortgages and other consumer loans, it's restraining demand. And in the case of mortgages, it's also locking homeowners who have 3 and 4% interest rates into their current homes, making realtors unhappy, I imagine. And these rates, like the Fed funds rate, are unlikely to be coming down much for the time being. Consumers also still feel squeezed by inflation, even though it's come back down fairly close to Fed targets, maybe a point too high on the CPI, a little bit less on the Personal Consumption Expenditures Price Index. Incomes have just barely kept up when you look at the average worker's wages or median income. So inflation is still a worry of consumers. Anything that pushes inflation higher again is going to be a problem for consumer sentiment. So the uptick this morning in the CPI isn't the best news we could have gotten. We'll see, how it goes over the next few months. Now to the bigger risks, at least the known unknowns. The main ones are around trade policy. President Trump, as you know, raised tariffs on friend and foe alike in his first term, but those were relatively narrow and in some cases were relaxed with new trade deals, for example, changes to NAFTA to make it the USMCA. This time, ignoring the occasional targeted threat, like against Denmark or Colombia, the tariffs promised both during the campaign and since the inauguration have mostly been broad and high. What's happened in the last couple of weeks, you have to look every day. First, we were going to have 25% tariffs on everything from Canada and Mexico. That's now steel and aluminum worldwide. So that's an issue. Those are inputs for manufacturing in the U.S. We've also got an increase of existing tariffs on China of 10% more, and we're still waiting to see whether we get these 10 or 20% universal tariffs and 60% on China that we heard about during the campaign and up to inauguration. What are the effects of such broad and high tariffs? Higher prices on U.S. consumers, not just on the imported goods, but on domestically produced goods that compete with imports. Higher business input and capital goods prices, contractionary effects on demand for non-tariffed goods, contractionary effects on business profits and investment, and high likelihood of retaliation from trading partners damaging export industries. So to put this risk in some perspective or context, let's look at just how important exports are to Georgia's economy. First of all, we're the 12th largest exporting state in the nation, $49.9 billion in 2023. That's been growing. Georgia exports at 6.1% per year on average since 2002. And in 2023, exports alone amounted to 6% of state GDP. You hit that 6%, you hit the economy of the state. The pictures here just show where the trade growth has been and where it stands in 2023. About a third of exports go to Asia, about a quarter to Mexico and Canada, 18% to the Euro area, and then smaller amounts to other parts of the world. So what is Georgia exporting? You probably know from your districts what your businesses are exporting, but I'll go over it. $9.1 billion of aerospace products and parts. $7.6 billion of chemicals, pulp, and paper. $6.3 billion of machinery. $5 billion of computers and electronics. $4.7 billion of food and agricultural products. And $2.7 billion of motor vehicles and parts. Finally, the ports themselves are economic drivers for the state. $234 billion of goods moved through Georgia ports in 2023, both, I forgot to correct that typo, sea and air. $234 billion of goods moved through Georgia ports in 2023, $167 billion of imports, and $67 billion of exports. Trade volume through our ports has been growing at a rate of about 8.5% a year since 2003. So again, the biggest risk to the state economy over the next year or two is related to federal trade policy. Where does that leave us as far as revenues? Well, y'all read the budget. This is where we've come from. We've had way above trend general fund revenues for 3 years running, above the long-term trend. Our budgeted revenues moved back toward that trend more slowly than we were expecting last year. These budgeted numbers, they are conservative, as they should be. We're budgeting. But they're not overly conservative. We've budgeted a 1.9% decline in general fund revenues for the amended fiscal year, but that's still 3.8% over the original fiscal 2025 budget, and already reflects the 20 basis point tax rate cut the governor has proposed. That rate cut has only a part-year effect on 2025 revenue numbers, taking about 40 basis points off the growth rate. The reason it's so small, and I know some questions came up over the fiscal note on that rate cut over the last couple of days. The reason it's so small is that by the time it's enacted and reduces withholding and estimated tax payments, we've only got a couple months left in the year. So the effect gets partly pushed out into fiscal 2026, keeping budgeted general fund revenue growth at 0.4% for 2026.
So you're addressing right now where you had the estimate at fiscal year 25 at 15.8 billion on individual income taxes, and now it's in the newly amended fiscal 25, it's down to 15.65 billion, and is that what you're addressing right now, I think? Is that correct?
The 20 basis point rate cut is in that. So without it, income taxes alone would be doing a little bit better, would be up a little bit. Overall, we'd be doing better than the 0.4%. I'm sorry, that was 2026. We'd be doing whatever I said, we'd be doing better than the 1.9% decline by about 0.4 without the 20 basis point cut this year. Now, I have not assumed a recession impacting either year at this point, just a continuation of modest real growth in the economy and personal incomes, together with lower inflation than we have been experiencing. Slower disinflation, though, than most were expecting even just a few months ago. That, of course, could change, but the risks are not excesses in debt or in the banking system, or even a major resurgence of inflation. They're really the risk of self-inflicted problems from federal trade policy is the biggest risk. So with that, I'll open it up to questions.
So So the estimate for the amended fiscal 2025, which we just passed out last week, your estimate on revenue for individual income tax, you've already accounted for the 0.2% that's not passed yet, right?
Correct. Yes.
Okay, so that's 150 million reduction, roughly.
Roughly, yeah, 150. And then it's 858 million in 2026, something like that. And then in 2027, it would go back. The effect would be smaller, as you can see in the fiscal note, because you're now on a normalized year basis. You
Yeah,
don't
the
have-
estimate for 26 is back up to another 40 million, roughly. It's above where we are now, which just a little bit.
Right, exactly. Yep.
All right,
And again, that includes the 20 basis point cut in fiscal 20.
Right.
This year's 20 basis point cut, as well as the effect that gets pushed from 2025 into 2026.
We got some questions. Chairman Newton.
Thank you, Mr. Chairman. I appreciate that. That is in-depth, and I'm sure you could go on further. On one of your slides, I know you talked a lot about tariffs. It does seem to be that economists, and a tariff, I guess, is kind of like or isn't it true that it's kind of a tax on a foreign company's goods that are coming into the country? Basically, we're
Well,
taxing that foreign company.
We tax the goods when the importer brings them in.
Okay.
And so we're taxing the importer who passes that tax along to whoever they're selling the goods to. It could be
So this
inputs
is-
to manufacturing. I mean, the steel and aluminum that we're tariffing now, as of yesterday, I guess.
Are there ever any companies, whether in Georgia or the United States, that benefit and therefore have more sales due to the fact that either illegally or legally subsidized company in a foreign country is now being taxed to make up for that government subsidy, for example, that allows them to sell cheaper here? Are there companies in Georgia that will benefit from a tariff, or as an economist, you never see a benefit to a tariff?
No, I mean, obviously, that's the classical argument for people advocating for trade restrictions, is to protect domestic industry and domestic jobs. And it does in those industries, the domestic producing industries that face import competition. It allows them to raise their prices.
And sell in any state in the country.
Right.
More.
Right. It allows them to raise their prices, which improves their profits, allows them to hire more people. But what's not accounted for in that argument is the effect that has on both consumers, but even more importantly, on the industries that buy tariffed inputs. So there was a study done in 2020 of the effect of the first round of steel and aluminum tariffs that started, I guess, in 2018. So in U.S. steel and aluminum industries, it added about 1,000 jobs. In industries that buy steel and aluminum as inputs, it destroyed 75,000 jobs by the study. So you've got to look at both. You can't just look at the industry that's protected from imports. You've got to look at who else is buying imports that are getting slapped with tariffs as inputs. And then also, obviously, the consumers who face higher prices.
So basically, even if a foreign company is being illegally subsidized by their government to try to strategically put all the companies in the U.S. out of business, for example, that from an economic point of view, it would still look bad to take away that subsidy by putting a tariff on it, according to an economist.
That happens. Yeah, some other countries do subsidize their domestic industries. I think our largest trading partners are Canada and Mexico. China's third. The EU together, all the EU countries together, and Canada and Mexico, I don't think they're the ones doing that. And the World Trade Organization is an outlet for resolving disputes like that. But yeah, we shouldn't reward bad actors. But the argument about other countries charging tariffs on American goods, it's kind of like if North Carolina raised their income tax rate, we decided to raise ours to be competitive with them. Because tariffs are a tax on your own consumers. So if China is taxing their citizens, does that mean we should tax ours more as well? I'm getting way off track here.
I think it's
and I
fair.
should add that these are my opinions as an economist. So I could talk here all day about trade policy, and trade theory, but
we got other people that have questions, and I think it's fair to say that those tariff slides probably wouldn't have been in your presentation the first time. So let's don't get bogged down on tariffs, but there may be some disagreements there. Chairman Jones.
Thank you, Mr. Chairman. Right here. Oh, yeah. Thank you. Just overall, looking at GDP growth, one of the things that concerns me, because I do watch that, is that even though we are the 8th largest economy in the union right now, New Jersey is pretty much right behind us, as is North Carolina. What concerns me more is New Jersey is growing at 2x our rate and North Carolina at about 3x our rate based on the last Fed data. If, as you look at it, I know you gave us information on the ports and you gave us information on import-exports, but could you give this committee very quickly, could you give us the top 3 or 4 drivers of GDP growth in our state? And then could you also give us the one sector where you're seeing, I'll say, double-digit growth, at least hopefully we have at least one sector with double-digit growth that we may be able to help focus on so that we can get our GDP growth maybe into the 1.2, 1.5 range?
That's you're asking me to have a lot of data in my head, so sorry. The latest quarterly numbers, I looked at what industries, as I recall, it was manufacturing industries generally that were among the strongest. I think construction was pretty strong. I don't remember all the details. I'm sorry.
Do you have anything on high growth?
I think it would be the things that you see in the news, the electric vehicle manufacturing and other transportation equipment would probably be the fastest growers in the manufacturing sector. Yeah.
Leader Hughley.
Thank you, Mr. Chairman, and thank you for the presentation. First of all, will we be able to get a copy of the slide presentation?
Yeah, sure.
Okay, so y'all are getting me off track with tariffs and those kind of questions, so let me make sure I'm clear. Right now, after the amended budget, what is the surplus?
What is the surplus?
What is the surplus?
The surplus or the reserves?
Well, give me the reserve, both.
Well, the surplus for fiscal 2024 was 2.6 billion, I think. It's 2.5, 2.6. The reserves, including the revenue shortfall reserve plus the undesignated reserves, are 16.4 billion, I think. This is before, if y'all decide to enact the rebate, that obviously takes a little bit off of it, and the budget includes taking in I forget how much, taking a little bit more out of reserves for one-time spending,
Okay.
capital projects, things like that.
So let me make sure I understand. In order to, you said that the budget already accounts for the 20 basis point decrease, right? So did we meet the requirement that would automatically take us to the next level, which would be the 10 points?
As of December 1, when the decision had to be made, we weren't quite at 3%.
We were not?
No. I mean, you can back into where we would be by taking the fiscal note impact of the 20 basis point cuts and just adding it to the general fund revenue forecast. I think if you do that for 2026, it would come in about 2.4% over AFY 25.
Okay.
But now the other two triggers met easily. So there's a look back test. The revenue for the latest full fiscal year, so 2024, has to be higher than the prior 3 fiscal years, and then we have to obviously have a certain amount of money in the revenue
So all
shortfall
three-
reserve. And
So all 3 of those things were met? Is that what you're saying?
the third one is the one that we didn't that we wouldn't have gotten to, but I mean that was a decision that had to be made on December 1, and we didn't see the revenues growing quite that strong, but we also the governor made the judgment based on the revenue outlook I presented to him, and obviously his own judgment, that we had a structural surplus
Okay.
that we could afford to give back. So on this graph, for the first couple years of that spike in revenues, we weren't sure how much of that was going to go away and move back down toward that dotted line trend. So the governor, being a conservative, a fiscal conservative, looked at that and said, well, let's see how much of that is permanent. How much of that is a shift up in the curve and not just a blip. And so he made that call that enough of it was sustainable that we could afford to give 20 basis points back to the taxpayers.
So on the graph that you have up there, looking forward to 27, 28 and beyond, do you think we're going to continue along that path? Is it going to go up, going to go down? What do you think the revenues are going to do?
Well, unfortunately, I didn't have a chance to turn this into an inflation-adjusted number. You'd be able to see it a little bit better. But the growth in 2021 and 22 was significantly impacted by high inflation. Prices at the stores are higher, so we pay more sales taxes. We demand higher wages. Our incomes grow. Hopefully, we're not going back there on inflation. Because it might be good for nominal revenues, but it's not good for real revenues because it hurts consumers. But anyway, yeah, you aren't, unless we get into a mess again with inflation, which I don't anticipate, you're not going to see growth like we had in 2021 and 2022 ever again.
So it'll be more steady.
Yeah.
Thank you, Mr. Chair.
Yeah.
Representative Mitchell.
Thank you, Mr. Chairman. Revenue derived from specifically that line item you had on tobacco was a very small portion, and I've been, as I understand it, Georgia has, if not the lowest, one of the lowest tax rates on tobacco that we have. Give me your projection, if you will, as an economist. What would happen if we were to raise the tobacco taxes, as some advocates are encouraging us to do, to pay for other items? Will it stay the same? Will it decrease because people will stop using tobacco products, or will we gain revenue? Then I have a part 2 to give you thinking of it. Fuel tax, I would love to get your projection on what that will be in the future, as there's an increased emphasis on electric vehicles by the present national administration, and I would love to hear what you would say, how that would impact Georgia.
Okay. Now I forgot the first part again already. The tobacco tax, yeah. I don't know if it's reached y'all yet, but there was a fiscal note just in the last week or so on a proposed tobacco tax increase. I don't have any personal opinion on that. I know that what people used to call sin taxes are they're called that for a reason. You're taxing smoking or you're taxing drinking, and the idea of any tax is if you want something to happen, less tax it. So if you want people to reduce smoking, tax cigarettes. But you've also got all the vaping products now, and so if you raise taxes on cigarettes, then it's likely that more people will switch to e-cigarettes and other non-tobacco cigarette products. The fiscal note takes all that into those kinds of behavioral responses into account. So you'll see that if you haven't gotten it yet, you'll see that as soon as you get the fiscal note. So there is, yeah, we would expect a behavioral response to a significant cigarette tax increase.
Don't want to butt in, but every single state in the nation has e-cigarettes, and they have
Oh,
a
yeah.
much higher tax rate than Georgia.
Right. I'm not sure what, I mean, yeah, higher taxes will reduce consumption, but it'll also raise more revenue because it won't reduce consumption that much. People who smoke are going to smoke. Since I was a kid, cigarettes have gone from 5 quarters in a machine to I don't even know what it costs now, $6, $7, $8 for a pack of cigarettes. So people will smoke less if you raise taxes, but they'll also switch to other products that you are taxing. So, yeah.
And the projection of revenue off of fuel with the emphasis on electric vehicles is?
Oh, yeah. Well, a few years ago, in the big transportation bill, I forget what year that was, 2015 or 17.
17.
Yeah. The excise, the motor fuel tax now is, the rate each year is a function of both inflation and changes in overall fuel economy of the cars in Georgia. DOR would have to explain how they calculate that, but the idea is that the more cars we have on the roads that are burning gas only part of the time or not at all, that brings the average fuel economy up, which forces an adjustment to the excise tax to make it higher. Now, obviously the problem is you're only taxing gasoline and diesel, obviously, but and you're not taxing the electricity. Well, you are taxing it, sales tax, when you plug in at home, but you're narrowing the tax base for the fuel tax as people switch to electric vehicles. So, at some point you have to raise the rate faster and faster. It's something that, I guess your tax writing committees are going to want to address at some point. What happens when we're all driving electric vehicles? We've got to find some other way to fund roads, but that's an issue that's been around for a while.
I've got one final question, or at least from me. The lottery revenue estimate, are you involved in that at all? No. Okay. All right, I've got questions about that. So, any other questions? Members, we have several other bills in our committee. We will be hearing those in the near future, just so y'all keep that in mind. But if there's no other questions, thank you for being here and giving us the lowdown. Thank you. We're adjourned.